Hello, IPEM friends. We are coming off a period, Antoine, of very slow transaction activity because of COVID. It was an interesting environment to be a lender and someone who takes advantage of secondary market dislocation because returns this time last year were unusually high, quite frankly, but transaction activity was super low. So there were very few new deals being done, obviously, because the markets were so dislocated. As we wind the clock forward to this year and looking forward, we're seeing a tremendous amount of transaction activity. Markets have returned more or less to normal. Pricing is back to pre-COVID levels. Deal structures, I think, are a bit better. In fact, if I look back just over the last month or so, we've probably had the busiest pace of capital deployment that we've had in years. So just a tremendous amount of activity. What we're seeing over several years of development is really in the marketplace is a movement to higher quality transactions. A very interesting theme is if we go back 5 years to 2015, for the average deal that we did, the private equity firms on average were paying 10.6 times EBITDA, and there was about 5 times senior leverage and about up to 6.5 times total leverage, including junior debt. If we look at today or 2020, what we are seeing, in general, the private equity firms are paying 15.5 times EBITDA. And interestingly, the debt multiple is about the same. The senior debt has risen a little bit, about 5.5 times leverage. Junior debt has risen to about 7 times leverage. And so what that is telling us is purchase prices for transactions have increased by more than 50% over that period of time, or around 50%, whereas the quantum of leverage on average in the portfolio deals that we're doing has increased just very modestly, which is another way of saying that private equity firms are deploying more amounts of equity capital. The typical equity check has increased from about 38% 5 years ago to about 56% in deals today. We can call those moves to growth buyouts. I prefer just to say moves to high quality buyouts. As a lender, we want to lend to less volatile businesses. As an equity investor, it's a bit different. The volatility can be very good for you because you can make 5 or 10 times your money if you get the volatility right. One of the themes that I think has come out of the COVID crisis is a real focus on credit picking skills. And if you look before the crisis, there was a bit of a sense that what was really important was beta management and ETF style investing across the market. Whereas I think what we've seen is a validation of old-fashioned asset selection and old-fashioned credit picking skills. And I think from Park Square's perspective, we're incredibly focused on, is it a high-quality business? Is it stable and predictable? And for those sorts of high-quality businesses that are supported by excellent private equity firms, we'll step up and be very aggressive. And that's a point of distinction and differentiation. And I think one of the big takeaways from the crisis is underscoring the importance of asset selection, credit picking skills, because when you experience market shocks, it's important to have high conviction around what you own and to have chosen well. And I think that's one of the lasting lessons from the COVID crisis. Governments have actually done a pretty good job, and I would say France in particular, together with Germany, responded very effectively with a focus on supporting businesses. And I think the general scheme in both France and Germany has been very successful, worked well. Lenders have cooperated with borrowers to really put the health of the company first and make sure, that the businesses were going to be, well supported. And I think private equity has played a really important role there in generally stepping up and doing the right thing. I do think there's a risk now in terms of sort of overdoing the stimulus, and I think governments need to be careful that we're not going to reignite inflation around the world by kind of overstimulating things as we come out, because it's very clear from the underlying performance of companies, and we see this across our portfolio. Businesses are really performing strongly. I mean, I think the rebound in most sectors is dramatic. Investors in traditional fixed income, which account for a huge component of, for example, pension and insurance investment, there's just no yield left in traditional fixed income. It's impossible to make the math of a pension fund work with a traditional fixed income portfolio today. And that's created tremendous interest in the private debt asset class as a fixed income alternative. And the fact that we're floating rate in virtually everything we do is also very, very attractive, particularly for people who may be concerned that we might see inflation again in an environment where governments perhaps go a bit, too hard on the accelerator. I would say it's a time, for investors to be careful and look at managers who've had a long track record of performing, through crises. The most important one is a growing sophistication around private debt and an understanding that actually it's a pretty deep and highly differentiated asset class across a lot of different products, from mezzanine to large size credit investing to middle market direct lending to distressed to structured equity. And there's really a broad remit. And I think investors have become much more sophisticated around performance, who's good, who has a long track record with a low loss rate. And I think they're becoming more discerning around the private debt space. The initial driver of the private debt industry was banks retreating from the loan space. That trend continues, by the way. That trend is more important in Europe than it is in the US, because the banks have played an outside role in markets in Europe, whereas the US is a bit more capital markets oriented. Europe for years and years, especially in the leveraged loan space, has been a bank dominated market. So their withdrawal has been a bigger deal. I'd say now we're into another phase entirely where private debt firms have really become the relationship lenders for the private equity community. And private equity looks to the structural flexibility, the creativity, the speed and certainty of private debt lenders. I think you'll start to see that sort of second phase, if you will, of growth kick in. I think you're looking at generally very well-governed countries where there's a deep social safety net. There are lots of businesses in Europe where valuations are a bit more reasonable right now than the US. Where you've seen a big uptick in markets, frankly, in both markets. But industrial performance and corporate performance across our portfolio in Europe is terrific. And I think the European economy is really well positioned for growth coming out of COVID. There are a lot of old-fashioned, high quality, in many cases family-owned businesses in Europe, which I think are very, very well positioned coming out of this. We're going to see a strong rebound, and I'm extremely optimistic.